There is nothing that grabs the attention more than passive income. A constant stream of income with minimum effort is a dream come true. We're all dependent on money one way or another, but constantly trading your time for money isn't a recipe for a joyful life, and passive income solves that problem. The first thing that comes into mind when we talk about passive income is real estate, because you probably paid rent at some point of your life. You paid someone's passive income. Wouldn't it be great if someone else paid you every month? It's easy to understand how real estate can be turned into passive income. However, stocks can be as passive as real estate. There are multiple ways to profit from the stock market, and one of them is by investing in dividend stocks companies that share their profits with their shareholders at the end of the quarter. These are the companies that have already established themselves in their respective industries and developed effective business models that allow them not only to make enough profits to invest back in themselves, but actually distribute part of it to their owners. But before investing in any dividend stock, it's important to pay attention at a few things. First of all, how long the company has been paying dividends. Sometimes there are companies that are struggling financially and start paying some dividends in order to attract investors to raise their stock prices. So the longer the company has been paying dividends, the better. Another factor worth paying attention to is how often the company has been raising its dividend payments. Every single year, we have inflation of at least 1.5%. Sometimes it can go as high as 8 or 9%, like it has been happening recently. So it's vital that the company raises its dividend payments every single year. There is a group of companies that are called the King of Dividends. They've been raising their dividends for at least 50 years. But not all companies have been around for over 50 years. That's why it's worth looking at stocks that are not on the King of Dividends list. The best dividend stocks are the ones that sell necessities, products that people constantly come back for. Take antibiotics, for example. Since their invention in 1928, they've become a vital part of our lives, and it's almost impossible to imagine that people would stop buying them in the coming future. So companies that specialize in antibiotics and have been establishing themselves in this industry can expect a constant stream of income, at least in the foreseeable future. Coca-Cola is another example. Soft drinks have become an essential part of our beverage consumptions. Once you get hooked, it's not easy to stop drinking cola. It just turns into a daily habit. So if you're looking to create a real source of passive income through dividends, you have to look at the companies behind these stocks to understand their business plans. So let's take a look at some of the dividend stocks that can help you to create a monthly source of income of $1,000, $2,000, or even $3,000 per month. But before we do that, here is a little disclaimer. This is not financial advice, and everything that's said in this video is for educational and entertainment purposes. Give this video a thumbs up and let's dive in. Number 1. Johnson & Johnson. Before looking at its dividend yield, let's take a look at its products. First of all, this company is so old that it's older than some nations. It was founded in 1886. It's literally an American icon. Take a look at their most popular products such as Tylenol, the painkiller. I personally can't live without painkillers. I can't wait for my headaches to cure on their own, and I guess I'm not alone. You can already see how this product alone is a decent source of constant income for the company. Take Band-Aids or Jones's baby powder. It's one of the most popular baby powders on the market. It is really a necessity for every parent. They have an entire line of healthcare products, medical devices, and much more. If you look at its stock, it has a dividend yield of 2.38% at the time of this script. That's actually pretty good for the stock market, considering that a lot of companies such as Facebook don't pay anything at all, although they're almost a monopoly in their field. The best part about it is that it has been raising its dividend payments for over 5 decades. If 2.38% is not impressive, take a look at its stock price over the last 5 years. It has increased by 42%. Of course, that's nothing for the stock market, but that's the nature of stable dividend stocks. Their stock price doesn't rise much, but at the same time, they pay stable dividends, which makes them a perfect stock for passive income. Number 2. Energy companies. Energy companies are some of the best companies when it comes to dividends, but some of the worst when it comes to stock prices, especially when we are talking about traditional means of energy such as oil and gas. I mean, the business model is simple: extract the oil, refine it, and sell it. Of course, some money must be poured into R&D to keep improving the extracting tech, but that's the biggest R&D cost unless the company is heavily investing in renewable energy. The last 100 years have been the golden era for oil and gas companies. Of course, that golden age is coming to an end, but we still got a few decades left at best, especially with all of the conflicts around the world. Oil prices are rising faster than ever, trading at above $100 per barrel. ExxonMobil is a great example. It's one of the leaders in the industry with a market cap of $350 billion and a dividend yield of 4.2%. You have Chevron, which pays around 3.5%. BP has a dividend yield of 4.2%, or even Phillips 66, which pays an annual dividend of 4.25%. But be careful with oil and gas companies because their stock prices heavily fluctuate as oil prices jump up and down. Number 3. Procter Gamble. Everyone knows this company. It's a direct competitor of J&J, since it also specializes in a wide range of personal health, consumer health, and personal care and hygiene products. It has been in the market since forever, selling absolute necessities, which makes its business model perfect for constant cash flow. Over the last 5 years, the stock price has almost doubled. Again, not impressive, but the dividend yield of 2.26% is what makes it attractive. The companies that pay such dividends never experience such a significant rise in the stock price because their stock price rises only when investors expect the company to expand significantly or come up with a revolutionary tech in the future, such as Tesla. Tesla's stock price doesn't represent the company today, but what investors believe it is going to worth in the future. But such a business can't afford to pay high dividends because the goal is to make a lot of money in the future and not now. Number 4. Edison International. It's a utility company that provides energy. Its stock price is relatively stable, or at least it has been around 60 to 70 in the last 5 years. Nothing revolutionary, nothing complicated, just a boring company that provides basic necessities. The only reason I'm including it in this list is because it's a utility company that supplies the most populated state in the US, and it has a dividend yield of almost 4%. Number 5. REITs. REITs are the gateway to real estate because they allow you to get to the market with minimum capital. When you're investing in REITs, your investment is directly tied to the housing market, since that's what REITs do. They take investors' money and invest them in real estate. That's why they often have the highest dividend yields in the market. Annually Capital Management, for example, has 12.5% dividend yield at the time of this script. New Residential has a 9.2% yield. They have suffered enormously in the last 2 years since people struggle to pay rent, but are slowly recovering. But at the same time, you have to understand that rates will slowly keep climbing in the coming future, which will make mortgages more expensive, which can lower house prices. To make any decent income like $2,000 per month from dividends, you need to invest something like $500,000 to $600,000, assuming you will make an average of 4% if you're diversified. That's not great, but your assets are going to be liquid, which means you will be able to get out of the game if you need that cash urgently. Thanks for watching, and until next time.